Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action here. We're looking at stocks moving lower across the board. The Dow and the S&P on track for their second straight weekly declines for the day. You're looking at the Dow off just around 139 points, S&P off about 0.5%. Lots of worry just about what exactly it looks like for the path forward for the U.S. economy. Also, the pressure that we saw play out in regional banks this week, that's adding to some jitters here on the street. And let's get you up to speed on one of the big stories of the day, and that's the latest on Twitter. Elon Musk confirming that he has found a new CEO to run the company. In a tweet, he welcomed Linda Yaccarino, saying that she will largely be focused on business operations. Musk adding that he is looking forward to working with her to transform the platform into, quote, an everything app. Let's get to Yahoo Finance's reporter Josh Schaefer for more on this. Josh, what can we expect here ahead?
Yeah, Shauna, so it's interesting to sort of take a look at what this means for Tesla, right, and what that means for Musk. And it's been interesting to see how the stock has reacted. So you saw yesterday that the stock was up about 2% on the news. The news came out initially that Musk said that Twitter had a new CEO at about 350 yesterday. So you saw a quick bump. But what you're looking at now is what Tesla has done over the last year. The stock's down about 30% over the last year. And a lot of that came from Musk selling stock. So he first made that bid for Twitter last year in April. Shares were about $330 at that point. Tesla lost about half of its market cap over this whole process here as Musk bid for Twitter, then became the CEO of Twitter. It has been a large portion of what Tesla analysts have talked about over the last several months, this Twitter overhang, as they've called it. So now you're sort of getting to see, well, what's actually in store for Tesla. And I think that is what you're seeing in today's market action. The stock off about 2% today, and that's largely being attributed to a wide-ranging recall in China due to a braking and acceleration defect. And again, that recall in China does appear pretty serious. It's on almost every car that Tesla has ever delivered in China to some extent. It's a large portion of Tesla's vehicles in China. Now Musk is going to have to answer questions about the EV pricing wars that he has ongoing and where margins eventually fall to for Tesla. I think that's where Tesla investors are sort of focused now.
Yeah, certainly. And I guess my big question is he really going to move on? Because he's also saying that he's going to stay as executive chairman. He's going to stay as CTO. So I've got some questions about whether or not he's going to be able to relinquish some of those duties there and really fully focus on Tesla. But time will tell. All right, Josh, great stuff. Thanks so much.
Well, the meeting on the debt ceiling between President Biden and congressional leaders may have been postponed today, but talks are ongoing through the weekend, especially among aides. Washington is on the clock with a new CBO report saying the U.S. could be unable to pay its bills in the first 2 weeks of June. Let's bring in Yahoo Finance contributor Kevin Cirilli with the very latest. And Kevin, it appears as though there's a few items that have emerged as potential compromises.
Yeah, I think the one that, based upon my reporting, that I can tell you are these clawbacks to unspent COVID-19 pandemic money. That cash went out, that money went out to the states, and a lot of it went unspent. And so House Speaker Kevin McCarthy, a part of his proposal is to be able to get that back in order to offset some of these costs. You know, there is a huge factor, especially if you're looking from an investment standpoint, a trading standpoint, as to when this X date is going to happen. And you just alluded to it with this CBO report. Secretary Yellen, who's at the G7, she's meeting with the Banking Policy Institute folks next week. But she's been really out there pushing that the X date is going to be on June 1st. It might not actually be precisely on June 1st, and that's what we're getting from the CBO, from the Bipartisan Policy Center as well. It might be in the first half of June. That would buy congressional leaders, Chuck Schumer, Senate Majority Leader, Speaker McCarthy, McConnell, Hakeem Jeffries. It would buy them a couple of more days on the congressional calendar to get to some type of a deal in that X date. So if you're carefully watching that X date and the trading around that X date, you might have a little bit, I caution this, a little bit of more time. So that June 1st isn't an arbitrary deadline. Separately from that, as it relates to the X date, tax receipts, we got to talk about how many Americans paid their taxes this year. And, if there were many Americans who paid them and we have a lot of tax receipts, that would give the government more money to pay and utilize extraordinary measures to pay the $31.4 trillion debt with that debt ceiling. It would buy them some more time. So keep an eye on that. And Yellen's assessment of June 1st was in part, keyword in part, based upon that there would be fewer Americans who paid their taxes. It's looking like, according to the reports that I'm reading, I'm sure you guys are reviewing as well, it's looking like that there might be a little more time than just June 1st.
Kevin, what's the feeling down there on the ground, just in terms of the conversations that you're having? How optimistic lawmakers are that we are going to reach some sort of agreement before whatever that X date ends up being?
You know, it's such a good point. And it's truthfully, I know there's been a lot of political theater, to use some neutral words, coming out of Washington and cable news this week. Of course, I'm alluding to former President Donald Trump's CNN town hall. But let's focus on the policy, right? Let's hone in on this, because what he said in that town hall was that if it meant a default in order to get cuts to government spending, that he would be in favor of a default. There are two very important points based off of that assessment. The first is from a practical matter. Senate Republicans, I'm thinking of Senators Mitt Romney, Lisa Murkowski, John Thune, and others, John Cornyn, have come out and said that they disagree with that. So some top Senate Republicans are saying that they disagree with Trump saying that there should be a default, and that they all feel that they got to get to a compromise before the X date. So the Senate Republicans are saying they don't want a default, and that's a key thing to focus in on, which is notable. Secondly, Trump's the front runner right now, and there are two missing pieces to his economic advising team. I'm thinking of former Treasury Secretary Steven Mnuchin. He's missing in action. He's not advising this 2024 campaign like he did in the past two cycles for Trump. Gary Cohn, another sort of force who would have been in favor of getting to a deal, not advising Trump 2024. So the impact of Trump's rhetoric is that those two forces and those two networks that they represent aren't advising Trump 2024. Finally, everyone is saying, at least who I'm talking to, from Speaker McCarthy to Jim Jordan, head of the Freedom Caucus, on the Republican side, that they feel ultimately the debt ceiling will get raised. But the question is, will there be a technical default? That's why this ambiguity around the June 1st X date, the June 1st X date that Yellen said, that ambiguity is so incredibly important to monitor over these next couple of weeks as these talks intensify. But Speaker McCarthy came out and said they want to have another principal meeting next week. Look to see if there's a framework agreement. If there's a framework agreement that's met, that means that there's going to be a deal.
All of this, of course, means, Kevin, it's going to be a busy few weeks for you moving ahead.
I love, you know what, though? This is what we do, you know? I mean, this is it, folks, right here. You know, if you're trying to build wealth, I mean, and trying to figure out Washington's impact, this right here, it's all happening in D.C. What do I know?
All right. Follow Kevin Cirilli. That's the bottom line of all this. Yahoo Finance contributor. Kevin, thanks so much for that.
Have a great weekend.
All right, you too there, Kevin. Well, let's talk about the economic impact of this debt ceiling fight with Paul Krugman. He's a New York Times opinion columnist who has also won the Nobel Prize in economics. Paul, it's great to see you again. So we know that this is obviously an extremely serious situation. We talk about some of the warnings that we've gotten out over the last couple of days. Jamie Dimon saying that we're going to see panic as we get closer to that X date. Treasury Secretary Janet Yellen saying global economic downturn will likely ensue. How serious is this situation that we're in right now?
Well, we don't really know. We haven't never really gone through this before, but there are reasons. There are pretty good reasons to panic if we actually do have a technical default, because U.S. government debt is the foundation on which world financial markets rest. Basically, T-bills are the collateral of choice. They are the ultimate safe asset. And if it suddenly turns out that the U.S. government doesn't necessarily honor its promises to pay T-bills, then who knows? But it could be a cascading series of financial dislocations.
Well, and Paul, some would argue that the reputation has already been damaged, regardless of whether we go past that X date or not. I want to get to your framing of all this, because we're talking about the debt ceiling, potential compromises that could be reached, but you've said that get rid of the debt ceiling altogether. Why?
Yeah, the debt ceiling is fundamentally crazy, right? You have Congress votes. It votes on spending bills. It votes on tax bills. The end result of those bills is whatever happens to the budget deficit, and the U.S. government, if it's a deficit, has to borrow. And then Congress votes again on whether to allow the borrowing that is required by its own legislation. So you're basically getting, I think that someone's analogy was that it's like ordering a meal at a restaurant. You order everything, it's prepared, it's all about to be delivered to your table. Then you say, no, I'm not going to pay the credit card bill, and I'm walking out of the restaurant. That's not, that's an insane second step. None of this is about fundamental decisions about spending or taxing or the budget deficit. This is all about whether, for political reasons, the party that controls one house of Congress can force the U.S. to renege on promises it's already made.
So then, Paul, if that were to be fact, or if we were to see that happen, then how should Congress then, I guess, handle the government's borrowing limit, or really the government's borrowing then going forward if there's nothing keeping it in check?
Well, but there is. I mean, the government can't spend anything that hasn't been voted by Congress. Joe Biden can't go out and say, okay, I'm going to offer Medicare for all because I feel like it. It would have to pass that through Congress, which is not going to happen, by the way. It's a Republican president could not just say, okay, I'm eliminating the income tax because I feel like it. Congress would have to vote to do that. So removing the debt ceiling, I mean, nobody else has anything like this. This is a crazy kind of double jeopardy on government operations that makes no sense at all. The power of the purse rests with Congress, and it does not come from the debt ceiling. It comes from the fact that spending and taxing must be authorized by legislation.
Paul, you've said in the past you've gotten a lot of traction calling for the Treasury to mint a $1 trillion coin. Essentially, if we're talking about the debt ceiling here, why not use that provision to do that? But recently, it sounds like you've kind of switched a bit to talk about premium bonds. I mean, I ask this because while we're talking about the debt ceiling, whether there's a compromise or not, there are those who say there's got to be a whole other way to think about this because we're back at square one every few years now.
Yeah, I still don't understand why Democrats didn't use the lame duck session to just raise the debt ceiling to a level where it wouldn't become relevant for years. But the choices among different ways of possible end runs around the debt ceiling, they're all the economics. There's no difference at all on the economics. The platinum coin is, when you actually work through the mechanics, it's actually just a way to enable the U.S. government to borrow through the back door. Instead of having the Treasury sell newly minted bonds, it basically has the Fed sell off some of the bonds it already owns, and that ends up financing the U.S. government. Premium bonds is a way of issuing bonds that arguably would not count against the debt limit, at least not to the full value. But the difference is among these things, the economics is all the same. The economics is just that the government continues to operate as it has been operating. And it's all a question of vibes. It's all a question of, how badly does whatever method we take get misportrayed in the news media, really. It's not all about substance, because on the substance, there's no difference whatsoever among these different routes.
Paul, what's your assessment just of where things stand in the economy with the debt ceiling debate set aside right now? Because since the last time we spoke, we've gotten another print on the employment numbers showing that growth is in fact slowing. We have seen some improvement on inflation. Inflation is slowing. Is there still the probabilities, there's still the odds that we're able to get inflation under control and avoid a recession?
I think that the technically it's quite possible. I mean, we don't know for sure. And one of I sometimes think that the Bureau of Labor Statistics is just messing with our heads, because it's like alternate reports either make you optimistic or pessimistic. And there's something in, the last month's data has something in it for everybody, no matter what what your views are. But on the whole, it does look as if we are slowing without a large rise, without any rise so far in unemployment. Inflation is slowing. A soft landing looks technically possible, but it's very tricky. I mean, the Fed has enormous power, but it doesn't have fine motor control. It's, or as I say, it's sometimes the soft landing may be physically feasible, but you're trying to land a plane in dense fog with a lousy set of instruments that don't give you a very good idea of your current altitude. So whether they can stick the landing is a separate question from whether it's feasible. But so far, I mean, if you could think about what a lot of people were saying a year ago about how we would need years and years of extremely high unemployment to bring inflation down significantly, and inflation is down significantly and unemployment hasn't gone up at all.
New York Times columnist Paul Krugman, it's good to have you on this Friday. Have a good weekend.
Take care.
Well, we are just getting started right here on Yahoo Finance Live. Coming up, there is a new leader at the helm of Twitter, but what does it mean for the future of Tesla? We're going to discuss later this hour. Plus, which states are regulating the use of artificial intelligence to protect your privacy? We'll break it all down. And as mortgage rates decline for a second consecutive week, did buying get a big boost over the summer? We're going to talk to a Zillow senior economist on the latest housing hurdles, including what a debt default could mean for the cost of buying a home. We'll be right back.
Treasury Secretary Janet Yellen issuing a warning this week about the dollar amid the debt showdown in Washington. Ahead of her trip to Japan for the G7 meeting, she said that a default could have an adverse impact on the dollar as the world's reserve currency. And it also comes at a time where it's already under threat amid the rise of the yuan. Joining us now, we want to bring in Double Line Capital portfolio manager Bill Campbell, who just wrote a paper on this topic. Bill, you're the perfect person to speak to about this. So we talk about a time right now where we are in a period of rapid global change. Are we starting to see already the dollar lose its dominance? And how so?
Well, first of all, thank you for having me. And I would say absolutely, we are. We've actually been seeing this for a while. But I would like to expand the thinking on, the reserve currency status from, the crown being handed from one country to another to moving instead to a system of bilateral payments where I think what we're seeing over the past several years and increasing this year is countries are signing memorandums of understanding, such as between Brazil and China, where they're agreeing to disintermediate the dollar from the settlement of their trade and investment, and instead, settle in their own currencies. And this has multiple benefits for the countries outside of the United States. The most obvious is that savings when you export a good or a service and you receive a foreign currency, you need to figure out what you're going to do, with that foreign cash. And most of the time, you're going to go and buy a financial asset in that country. And what we've seen over the past several decades is many emerging markets have really moved themselves out of low income status to middle income status. They've developed broad and diversified economies. They've seen capital deepening, meaning they've seen their financial markets grow where they have domestic debt markets and strong domestic equity markets. And in a way, this is a natural progression to be able to settle trade in your own currency and then have your trading partner be able to invest back into your country, which supports consumption, investment, and growth and further development, going forward.
Yeah.
So that's what's happening in addition to some of the cyclical factors that, we're seeing.
Yeah, and Bill, to a certain extent, we've been talking about the potential of the dollar losing its dominance for some years now. It feels like last year was a big flashpoint, though, when you think about what happened with Russia, how quickly Western countries were able to move to freeze out Russia and its assets. Can you speak to that and to what extent that accelerated the thinking of some of these emerging markets who said, we can't just be holding our debt all in dollars anymore?
100%. I think you hit the nail on the head that the sanctioning of Russia debt, hit on many levels. The most obvious of which is, the quick weaponization of the dollar, that has been discussed, that countries are saying, wow, we could actually have all of our dollar savings effectively frozen and unusable. But think about it from a U.S. saver standpoint. A lot of 401ks, a lot of institutional money managers invested in Russian sovereign debt, for example, because it's a large part of many of the international indexes. And all of that money was effectively frozen and, defaulted on as well. So that actually hurt the U.S. savers and U.S. retirees. So, from a diversification standpoint, not only from the international, but from the domestic side, too, you start to wonder, does it really make sense to have all of our savings tied up in a system that, you could effectively be frozen out of? The final element of it is when you are dependent on a single world currency for all trade and financial settlement, you lose your independence in foreign policy. So, for example, Europe, some of the European nations may not have wanted to take as aggressive a move as the United States wanted to, against Russia due to, energy linkages and energy dependence that they had with Russia. But in effect, they had to because the United States forced it. Emmanuel Macron actually made statements when he flew back from China, effectively saying that he lost his independence on foreign policy because of that. So for those three reasons, you can see why the reserve currency status is threatened by that action that was taken.
Bill, the natural question here is who then replaces the dollar? I mean, the Chinese yuan one that people have looked at, but, I'm looking through your paper here. You've made examples of Brazil as well as Malaysia. How much of that has to do with the dollar and the U.S.? How much of that has to do with the pressure coming in from China saying, look, the debt needs to be held in yuan if you want these big deals? I mean, they have been pushing for that for years, especially through Belt and Road.
Okay, I think there's several items there, and you hit on some very key points. First of all, China absolutely wants to push for, more settlement in their currency, as that gives it more freedom internationally to, engage in foreign policy, foreign trade outside of, the U.S. periphery. But secondly, bilateral trade goes in both directions. So, as much as there's imports from China from these countries, there's also from Brazil exports of commodities to China. Then the Chinese hold Brazilian reais. That savings of reais gets reinvested back into Brazil if the dollar is disintermediated. That savings that the Chinese invest back into Brazil gets put into their financial system and eventually works its way through the investment and the consumption channels, boosting the economy of Brazil. So it's a symbiotic relationship when you start looking at a bilateral system of payments whereby we disintermediate one single currency as the de facto settlement currency. And we move and allow countries to settle bilaterally with their own currencies without having to use a third independent currency to settle. And again, I think the benefits that are going to be reaped from that present a lot of opportunities for international investment, especially emerging market investment over the coming years and decades. And I think from the standpoint that over the past decade and a half, the U.S. really has been the only show in town. A lot of foreign savings got invested back in the U.S. As we've seen, there was last year about 25 trillion of portfolio investment from outside the United States sat in the U.S. But now what we've seen in the past year is many local equity indices are doing just as well, if not better, than the U.S. index. And if we have currency weakness, that's going to be a tax on that savings as well. And the change in monetary policy, increased monetary policy rates by the U.S., increases the cost of hedging. So what we could see is a lot of that savings that sits in the U.S. going back home and being reinvested in domestic countries, further boosting the case for growth, for investment, and for trade in all sorts of countries outside of the United States.
Certainly big changes underway in regards to that. Well, Bill Campbell, great to have you, Double Line Capital Portfolio Manager. Coming up, Linda Yaccarino is set to become the new CEO of Twitter, but what does it mean for the future of Tesla? We will discuss on the other side. Stay tuned.
Welcome back to Yahoo Finance Live. Shares of Tesla down about 2% right now, with about 30 minutes left in the trading week after Elon Musk tapped Linda Yaccarino to run Twitter. For more, we're joined by Ross Gerber, Kawasaki Wealth and Investment Management CEO. You got a long title, Ross, but we like to talk to you because you've got investments on both. You've got investments on both sides of things. You've kind of become the public face of investor frustration for Tesla, but you're also invested in Twitter. What do you make of the announcement here?
Oh, I couldn't have been more happy. I mean, this is what I've been pushing for months. Find a great CEO for Twitter that will complement Elon's technology skills with somebody with a media background. I've always felt Twitter was a media and entertainment company before it was a technology challenge. And that was something Elon and I differed on. And it looks like he finally came around and found just an A-plus CEO to run the media side of Twitter. So that's exciting as a Twitter shareholder. And it's even more exciting as a Tesla shareholder because it'll free up Elon, I think, to spend a little bit more time on Tesla and focus, but also having him not have to deal with some of the more difficult and controversial issues that come in with the politics of running Twitter. So that creates another face to deal with some of the incredibly challenging issues of running a media company.
Ross, so is the Twitter overhang, though, really gone? Because at the end of the day, he's still executive chair, he's still CTO, and we know that he likes to have control over what he is invested in.
Yeah, I think it's gone in the sense of we now have a clear vision of what management will look like at Twitter, and his role will decrease in the amount of time and energy it will take as time goes on and the product stabilizes and the technology and the team gets better. But I think it's really about being the face of Twitter that puts Tesla shareholders at risk because of all the political challenges of running such a difficult company. And so by having somebody else being the CEO, it really deflects, I think, a lot of the negative, hopefully deflects the negative criticism that Elon's got, which has definitely hurt the perception of Tesla in the consumer marketplace, especially in very, very important markets on the West Coast. So this is a win across the board because she's such a great person for this role.
A number of other headlines driving Tesla shares today, one being the recall that's happening over in China. Put this in context for us. How concerned
it's like this recall, this recall thing is like talking about horseshoes and horses. It's like you don't recall cars anymore the same way we perceive a recall, that we're going to have to drive our car back and get some physical part fix. That's not what this is about. These are software updates, and the terminology needs to change from calling these things recalls versus software updates that take 30 minutes for your car to update while sitting at home. So I think these things get blown out of proportion in the media, and I really don't understand why, when it's like literally the owners of these vehicles don't have to do anything. So there's no cost to Tesla. So, it's a lot of news headlines, lots of clicks, but in the end, Tesla just updates their cars and they work great.
Ross, what do you think about the pricing strategy? Because that obviously has been a huge focal point here among shareholders, among investors over the last several weeks. And we've seen Musk reverse course a couple of times. How much of it do you think, how big of a boost do you think the price cuts have done with demand? And as a result, how worried are you about some of the pressure that we have been seeing on price margins?
Right. So this has been the area that I've been really concerned about because I view Tesla as a premium brand, and I think it should maintain its margin at minimum of 20% on vehicles. And we saw that decline in Q1 to sell these vehicles at lower prices. And that's really what hurt the stock and concerned investors is, obviously demand for Teslas are not meeting supply. And so they lowered the prices aggressively to create an equilibrium with supply and demand. But unfortunately, that's not the best way to sell cars or premium products by having a dynamic pricing model like hotels. And so I think it's very confusing for consumers. And I think consumers who bought vehicles in Q4 felt burned because they paid, let's say $65,000 for a car that they could now buy for $46,000. And that really doesn't leave customers happy who bought cars in the quarter before. And so this strategy to me has been really, haphazard and disjointed, and it's caused a lot of confusion. Now they're raising prices because demand has picked up. I think Tesla needs to decide this is how much our cars cost minimum. And if commodities costs decrease enough to lower prices and maintain margins, that's great. But Tesla needs to use tools to create new demand from the 90% of American consumers that drive gas cars and really don't fully understand the value proposition of an EV. And there's tremendous amounts of pent-up demand if the public's educated, and that's where Tesla needs to go now that it's a mature company selling 2 million cars a year.
We will see if it does go there. Well, Ross Gerber, always great to have you.
Yeah.
Gerber Kawasaki, Wealth and Investment Management CEO. Thanks so much.
Thanks for having me.
All right, well, coming up next, 3 stocks to watch as we get closer to the closing bell on this Friday afternoon. We'll be right back. It's time for a triple play. 3 stocks that we're watching in the final 20 minutes of trading for the week. We have Lyft, First Solar, and Netflix. Kicking it off with Lyft CEO David Risher telling Bloomberg earlier this afternoon that the ride-hailing company is open to offers for acquisition. Now, Risher had also told our own Brian Sozzi last month that the company is, quote, always looking at options, and people approach us from time to time. Lyft, of course, has been struggling to keep up with Uber or even compete with Uber at all. Disappointing revenue outlook, sending shares tumbling following its most recent earnings report. Ali, when we take into account what exactly Lyft has to do to slowly eat away at that market share, I think more and more people are talking about a possible M&A target from somebody else. That might make the most sense.
Yeah, and you wonder who would want to pursue Lyft in that possible acquisition. I am a notorious rideshare user. I take Ubers and Lyfts way too often. And anecdotally, I've noticed that Lyft is cheaper than Uber. And Bloomberg did have a chart that goes to show consistently in various parts across the US, you'll see that the price of Lyft is cheaper with those lower fees. But at the same time, Bloomberg posted a separate chart that shows Lyft's share of riders is just so below Uber's, as you're seeing right now. And you alluded to this. They are a struggling company. They had to lay off 26% of its workforce. But there is that risk of a rideshare monopoly. And you have to wonder if Uber maybe wants Lyft around because of antitrust concerns. We've seen the FTC being really strict. So it'll be interesting to see how this story plays out.
Well, and as a user, Ali, I'd wonder if prices are going to remain as low as they are right now if we've just got Uber in a big way. You know, look, you really focus on the key issue here with Lyft, which is that these acquisition rumors have gotten louder and louder because of the struggles the company has had. You pointed to the roughly 25% staff cut that we saw, or layoffs that we saw most recently. That came after another round of cuts in November. And at the end of the day, this goes back to Lyft's strategy. They have really doubled down on ride hailing. When ride hailing was struggling at the height of the pandemic, Uber went in another direction. We have seen them rewarded in a big way. So one to watch here to see if there are any suitors potentially that emerge. Now, my pick for the day is First Solar. The clean energy company announced a $38 million acquisition of Swedish firm Evolar AB. First Solar saying the move allows the company to accelerate development of photovoltaics, with Evolar a leader in thin film, which is used in solar panels. The stock surged on the news. We are seeing it up in a big way, more than 25%, largest increase or at least on pace for its largest increase since April of 2013. And this is a company, guys, that I've been watching really closely because it is the largest solar manufacturer headquartered in the U.S. And they've offered a bit of a different take from some of these other solar makers, which is to say we're going to rely on manufacturing in the U.S., bring everything on board here, as opposed to some of these other solar players who have largely had to rely on China, and now some players in Southeast Asia as well. So First Solar being rewarded in a big way. Last year, they had another expansion of $1.2 billion. So they have been ramping up very rapidly here. The announcement today, just the very latest for the company.
Yeah, certainly we're seeing investors very excited about this announcement. We're also seeing some of its competitors out there rise alongside of it. Roller Edge Technology is also moving to the upside. Enphase Energy is also gaining today. And Akiko, you make a great point just in terms of the supply chain and what they're doing in terms of future manufacturing, because we know supply chain and higher costs has been a massive issue here for the industry overall. So First Solar is really moving here to produce more in the U.S. That could really be a differentiating factor here going forward, Allie.
And if you just take a look at this yearly stock, it is insane. It is up more than 270%. And I do think U.S. adoption of solar is picking up. My parents, they just put in solar panels at their house. So I do think this acquisition was a smart one as First Solar looks to expand its footprint. And moving on to my pick today, that's Netflix. As the streaming giant shares, they're moving to the downside. They're off about 1.5%, echoing the declines that we're seeing in the broader market. And it follows a new Wall Street Journal report, which revealed the company plans to reduce its spending by $300 million this year. Netflix, of course, is a notorious spender in the streaming wars, but it's looking to cut costs after pushing that broader password sharing crackdown into the second quarter. According to the Journal, there will be no hiring freezes or layoffs as a result of this pullback, but management has been told to be cautious with their spending. And guys, this is something that we're seeing really across the media sector right now as investors shift focus to profitability and look to stem those streaming losses. We just heard from Disney. They are looking to slash $5.5 billion worth of costs, which include $3 billion in content costs. So this is something we're seeing across the board.
It is something we're seeing across the board, although I will say that Netflix is better positioned than many of its competitors out there when it comes to the streaming space, and the fact that they have been profitable now for quite some time. When we talk about the cuts that we're doing, it's also important to put into perspective how small they are in relation to the overall spending that we typically see from Netflix, because operating expenses last year were about $26 billion. So yes, they are moving to be more conservative, but when you take a look at a whole picture, they still will probably be spending a heck of a lot, Akiko.
Well, and I keep wondering, how much of this is influenced by the other. I mean, you talked about the cuts at Disney. Now you've got Netflix. At the end of the day, though, I keep looking at some of the major tech players in the space that aren't pure streaming plays, right? You look at Apple, you look at Amazon. They've got a little more money, especially Apple, to spare here on content at a time when the pure streaming players are having to pull back because of a pullback in ad spending as well. So an interesting one to watch here to see who actually can take advantage of that when some of these names are cutting back on content spending. Well, coming up, how is your state protecting you against artificial intelligence? We're going to break down the latest AI legislation right after the break. Stay tuned. The European Union took a big step this week towards passing legislation to regulate AI tools, including ChatGPT. Lawmakers agreed to strengthen draft legislation to include a ban on the use of facial recognition in public spaces and also called for more transparency around programming and use of generative AI. Here in the U.S., that discussion has been playing out largely on the state level. Let's dive deeper on this with Goli Madavi, Data Privacy and Security Council member at Bryan Cave Leighton Paisner. We've also got our very own Alexis Keenan joining in on the conversation. Goli, it is interesting. We should preface this by saying that, look, conversations around regulation about AI have been going on for years, but it does feel like the developments around ChatGPT have really accelerated that. To what extent has that raised the urgency?
Well, we are absolutely at an inflection point. We have mass adoption of AI tools across enterprise. We are seeing now consumers jumping to use generative AI tools like ChatGPT. They have something like 100 million monthly average users. And so legislatures and legislators are feeling a real push, feeling pressure to put laws in place to protect consumers.
Goli, it's Alexis here. By the end of this year, we will have had 7 states in the United States that have enacted laws that protect consumers and job applicants against what they perceive as threats of AI. Things like whether to offer insurance to an applicant, whether to offer a job, things like loan products, financial products. What exactly are these states that have enacted these laws? And can you give some more specifics as to their guardrails?
Absolutely. And so we can group the consumer privacy protection laws in California, Colorado, Virginia, and Connecticut together because they generally follow the same framework. These laws, which apply to the use, collection, and sharing of personal data, also regulate artificial intelligence tools to the extent that these tools make automated decisions that impact consumers in the areas of health, insurance, financial services, employment, and housing. In other words, automated decisions that are impactful. And so what we see under these consumer privacy laws is that where businesses use automated decision-making tools in these high-risk areas, they need to provide notice to consumers that they're doing so. And within that notice, they need to provide a description of the logic that is used by these tools. They need to provide consumers with choice. Consumers need to be able to opt out of having their personal data used in connection with automated decision-making. Also, businesses will need to perform impact assessments. In other words, they need to look at the benefits that the use of automated decision-making tools provides to the organization and to consumers, as well as the potential risks in using these tools, and then implement mitigations to minimize the harm to consumers in using these tools. And so this is what we see in terms of the consumer privacy laws. And then we have a handful of employment related laws that are specific to hiring and promotion. We see that Maryland and Ireland both have existing laws on the book that impact the ability of a company to use facial recognition software in Maryland during the course of an employee's interview. In Illinois, it's related to using AI technology in connection with videotaped interviews. And of course, New York City is grappling with its own law right now, which governs generally the use of automated employment decision tools in the course of making employment decisions.
Goli, you mentioned their assessments for risk and compliance are part of these laws. I'd like you to explain whether you think there's a particular industry or industries that face the most challenges in terms of complying with these laws, even though we're not at the point where we have a federal law on the books.
Well, anytime you're grappling with a patchwork of state laws, it kind of brings the compliance risk up, because there is no universal standard by which companies can tie their compliance programs to. In terms of industries that are likely to be more heavily targeted, of course, regulators are focused on automated decision-making where those decisions impact consumers in a very real or legal way. And so again, we're talking about housing, employment, insurance, criminal justice. And so that's really where regulators are going to be focused.
Goldie, you mentioned sort of the compliance risk that comes with a fragmented approach, which is what we're seeing right now. I mean, how much muscle is there really behind this legislation if there's nothing at the federal level?
Well, enforcement is going to be important, and that really remains to be seen. We know that in California, there is a dedicated consumer privacy agency that has its own budget, and they are currently staffing up. So we can expect that come July, when the enforcement date comes, there will be an enforcement sweep. So we know, at least in California, companies should expect that there will be active enforcement of consumer privacy laws and AI legislation. The other states are going to be governed, obviously, by those states' attorneys general. And it's not clear at this point whether or not those laws have adequate budget and staffing to really go after the bad actors.
Goldie Mondavi with Brian Cave Leighton. Appreciate you walking us through what is a very complicated landscape right now. And our thanks to Alexis Keenan as well.
Thank you.
Well, Apple is reportedly inching closer to releasing its long-awaited mixed reality headset. Yahoo Finance's Ali Garfinkel is here with the details on that. Ali, what are we learning about the timeline?
Hi, Shauna. So the important thing to know here is this product has been in development for about 7 years. And we are finally a few weeks away from WWDC, the June 5th event where Apple is expected to unveil it to the world. Now, to say this is much anticipated is probably an understatement. If I had a nickel for absolutely every time that someone had just told me a rumor about this headset, I would probably be a lot closer to retirement than I am right now. However, we're getting some reports that the payoff isn't going to be quite what VR watchers, VR advocates had hoped for. Now, what do we mean by that? Let's think about what an Apple product usually is like. We usually imagine something that is streamlined with a beautiful UX and is plugged into this very sticky, very usable ecosystem. But the reports are saying that this Apple headset is going to be more experimental than anything we've seen from them before. Now, what does that look like? For instance, we know they're having some struggles integrating software. We know that the battery pack itself is going to be, for instance, bigger than expected, about the size of a hand, give or take. And we also know that there could be production issues down the line. Now, we've been talking for a while about this headset possibly creating an iPhone moment, a ChatGPT moment. However, what I'm hearing from sources on the phone today is maybe as this report came out, we should start tempering our expectations just a little bit.
Well, Ali, with mixed reality, the question is always about whether the content will follow. Is there an actual demand out there with limited content right now? We've seen those challenges with Meta. Are we likely to see the same uphill battle with Apple?
I certainly think so, because you're absolutely right, Akiko. There is not a hero VR app out there right now. And I think the other thing, too, is we have to remember why Meta has so struggled to keep consumers interested in its VR headset. And it comes down again to that ease of use. I know I'm hitting it home, but I cannot stress how important that really is. The other thing, too, is if Apple doesn't bring a killer app, that kind of streamlined quality that makes you just want to pick something up and wear it and use it, it's going to be a lot harder for, I think, VR to be as sticky as I know company watchers, as I know VR advocates are hoping it will be. In the end, if VR is sort of left without this hockey stick moment, I think the industry at large, not only Apple, not only Meta, but everyone who's interested in VR is going to be sort of left to grapple with how far the technology really still has to come.
I'm not sold on it yet. You know that, Ali. I've got a lot of questions about the adoption of this going forward, but we'll see. Maybe I'll be proved wrong with this new headset. All right, Ali Garfinkel, thanks so much for joining. Have a good weekend. All right, well, coming up, we are counting down to the closing bell on Wall Street. All three of the major averages trading to the downside. You're looking at the Nasdaq off about 0.4%. We'll be right back.
We are minutes away from the closing bell. Let's bring in Yahoo Finance's Inez Ferre for a breakdown of the market action. Inez.
Hey, Akiko, and we are going to end the session off the lows of today. Take a look at our Wi-Fi Interactive. The Dow relatively flat right now. The Nasdaq lower as well as the S&P 500. But if I pull up a 5-day chart, you will see that the markets are mixed for the week, with the Nasdaq eking out a gain for the week. And that mainly has to do with two names. I'll get to that in just a second. In fact, I'll get to it now because you can see here mixed action for today, but over a 5-day chart, check that out. Amazon up more than 4% and Alphabet 11% gain for the week. You've also got Netflix, which gained more than 5% for the week, as well as AMD. Over on the Dow, and sticking with that 5-day chart, you can see the losers for the week for the Dow, those being Nike, Disney, Intel, American Express. Also checking out what's been happening with cryptocurrency over a 5-day chart. Bitcoin down 4.5% over the last 5 days, hovering just above 26,400 per token. And then looking at the regional banks over the last 5 days, you can see underwater for the regional banks, since we saw pressure on those regional banks earlier this week. This is the intraday action, though, for today now. And then looking at what's been happening with commodities, we have been watching oil throughout this week. Here's the closing bell.
All right, that's the closing bell on the street here, wrapping up what has been a pretty volatile week when you take into account all the selling activity that we had seen in some of those regional bank plays. But as we wrap up the week, all three of the major averages lower for the day. The S&P lower for the second week in a row, falling by just about 0.3%. It's actually the sixth week in a row that we have seen the S&P move less than 1%. Akiko?
And Shauna, one of the big stocks in focus today, shares of Tesla. Let's take a look at how they closed the day today, because a number of headlines driving the moves there, down about 2%, 2.4%, let's say, after Elon Musk tapped Linda Yaccarino to run Twitter. This comes at a crucial moment for the EV maker as the China recall, dwindling U.S. demand, and an EV pricing war putting pressure on the stock. It's important, I guess, Shauna, to kind of differentiate all of those. There's obviously the Twitter news that came out. The expectation here, or the hope, I would say, among Tesla investors is that allows Elon Musk to focus a little more on Tesla. We heard from Ross Gerber over at Gerber Kawasaki earlier that the recall, the 1 million cars being recalled over in China because of braking issues, he thinks that's a little more smaller because it is about software updates, not necessarily a wholesale recall as he describes it. The pricing war, which I know you've been watching closely, to me is one to continue to watch. We did see Tesla hike prices for all their models except the Model 3 yet again, but there's a lot of competitors in the market right now.
There certainly are a lot of competitors out there, and I think Tesla's kind of struggling with the fact how low they want to bring prices in order to increase adoption versus that they want to keep them in check because of the pressure that we have simply seen on their margins this past quarter. In terms of the analyst reaction, I think analysts are pretty split on this idea. We heard from Dan Ives of Wedbush in the past that it's short-term pain for long-term gain. I think others a little bit more skeptical just in terms of what exactly this means for Tesla's bottom line going forward. But Ross Gerber, he was pretty optimistic about the new CEO that was named at Twitter, what exactly that means for Elon Musk at Tesla. He was very encouraged by it, saying that he believes it is going to free him up just a bit. I think to the degree of that is what people are debating right now. Let's move on to another big mover of the week, and that is PacWest and some of the other regional bank shares, wrapping up a roller coaster after the bank confirmed that deposits had been falling as it does explore options to survive. Now, in terms of the deposits falling, there was a 9.5% drop that we have seen in total deposits last week. I want to point out, though, that most of those outflows, the bank said, happened on May 4th and May 5th. And why that is critical here, Akiko, is because that came after the reports that it was exploring a sale. So it did spook some customers. But as has really been the story of many of these regional banks over the last several weeks, it's really a story about confidence rather than some of the fundamentals of these banks.
Well, and that's had a lot of people scratching their heads over the last few weeks to say, look, we've had analysts on who say a lot of these banks are financially sound, and yet the headlines just don't look good. And there are some jitters. We started to see a bit of a differentiation towards the end of the week, though. Names like Western Alliance moving higher because they said their deposits increased. So all the regional banks not necessarily being lumped together as they were in the early days of the banking crisis. But we'll see. It feels like every week we move in a different direction. So we'll be watching very closely on Monday. Netflix shares closing in the red today after a new Wall Street Journal report revealed the company plans to reduce its spending by $300 million this year as the streaming giant aims to cut costs after pushing its broader password sharing crackdown into the second quarter. We talked about this earlier in the show, Shauna. Netflix not the only streaming service struggling here, but we'll be watching to see what this means for the content output. There's a number of other headlines as well, certainly, that are moving for the company, especially with the writer's strike, a number of other headwinds, and of course, the slowdown in advertising as well.
Yeah, certainly some challenges here for Netflix, and you can really say it across the board here when you take a look at some of the changes and some of the announcements that have come out of the streaming space over the last several months. When you take into account what Netflix is doing, they're doing some things in order to potentially head off some of those challenges. They did say that they are expanding their password crackdown. That's expected to come here to the U.S. this quarter. Also, their ad tier had been reportedly gaining some momentum. So I think the big focus on the street is that whether or not that trend is going to continue this year. So yes, Netflix being forced to cut costs, $300 million, a bit of a concern here for investors just in terms of how that positions them against some of the other players in this space. But I think it's just a sign of the times, a sign of the fact that the ad market is still struggling a bit. So these companies are being forced to make these types of tough decisions.
Certainly are. Well, moving forward here, debt limit talks between President Biden and congressional leaders have been pushed to next week, but the uncertainty is already weighing on some industries. Joining us now is Bradley Sachs, Semaphore business reporter. Brad, we've been talking so many angles on the political discussions that have been playing out in Washington, D.C., what this means for the credibility of the U.S. What are you hearing from businesses about the biggest concern going into June?
Yeah, it's catastrophic if we actually hit a default. Lending will obviously slow down. You're going to see small businesses to multinational conglomerates all pulling back on spending, pulling back on hiring, pulling back on expanding because they're uncertain. Even if you look at something not necessarily like like an individual business, but the equity market as a whole in 2011, we didn't regain the losses that we had until midway through the next year. This could potentially be worse. And any kind of cut back on spending, cut back on hiring is going to have huge impact on the economy because the recession is expected if we do default.
Bradley, from the reporting that you've been doing, are CEOs, are they changing at all? Are they shifting their strategy as a result of this risk? Or what could you see happen as we get closer and closer to that X date?
I think the reality is this year's already been a very cautious year for a lot of executives. We came into the year with interest rates rising, with a tight labor market, and I don't think there was a ton of confidence in the economic prospects a year out going into this debt ceiling fight. This is just it's another headwind in the macro environment for any executive. And so I think it just has them batten down the hatches even more.
Bradley, I know you also cover the crypto space. I'm looking at the moves today. Bitcoin seeing its worst week since November. There's a liquidity concern here as well, but I have to wonder, in the context of what we're talking about right now, how much flows are you seeing moving towards crypto as a potential hedge? And more importantly, if you look at the moves we saw today, what was the biggest headline that drove that?
Yeah, and I think Bitcoin, even going back to what advocates hoped it would be, a potential digital gold, it didn't really act like that in certain market stress. We almost saw it act as a growth asset when interest rates were low. It was surging, while when things were getting a little hairier, it was struggling, was dropping. I think the recent bounce back in this year has proven out a lot of some of the original hopes for the cryptocurrency, and it's a big test. If we do hit the X date and there's no deal reached and the U.S. does default on its debt, if Bitcoin surges, if it holds steady, it's going to be like a great test case for anyone who's advocated for the cryptocurrency, for anyone who's been invested in it, and I think this will be like its biggest challenge yet, right? It's taking on something that it'll prove if it's a safe haven asset or not.
Bradley, when you take into account, I guess, the downward trend that we have seen in Bitcoin as of late, in terms of what is needed to be the catalyst to the upside, what do you think that needs to be in order for Bitcoin to regain its momentum?
Well, I think it's general anxieties around the crypto space. We have in the U.S. specifically regulatory issues. Talking with crypto companies based here, they have no idea what places like the SEC, like the CFTC, are going to do with the industry. Even though companies like Coinbase are not directly correlated with Bitcoin, that is going to weigh on the assets prices if U.S. regulators aren't making it easy for U.S. investors to buy the crypto in the country or buy the currency in the country. And so I think that has been weighing on a lot of investors' minds. And beyond that, like we haven't seen the banking crisis that we had unfold really surge and help the price. And I think that was a test case as well, almost as lead up into this default debate as how is it going to act as a safe haven? And so far, it didn't hit exactly the notes I think some crypto advocates would hope for.
Semaphore business reporter Bradley Sachs there. Good to have you on the show today. Have a good weekend.
Thank you. You too.
Well, coming up, consumer sentiment took a big hit in May. We check in on the state of the market with Citi economist Nathan Sheets on the other side.
As investors wait for a debt limit decision, confidence in the economy is taking a major hit. University of Michigan's Consumer Sentiment Index for May coming in worse than expected, falling to its lowest level in about 6 months. For more on the state of the economy, we want to bring in Nathan Sheets, Citi Global Chief Economist. Nathan, it's good to see you here. So certainly just reflected in the University of Michigan print, obviously consumers getting a little bit more nervous about where the economy is headed. What are you seeing in the data that you're looking at in terms of consumer spending and how people are adjusting?
I think the general tone of this Michigan survey is very consistent with my impression of the economy, that on the one hand, the absolute level of the reading remains above 50, suggesting that the economy continues to expand, that consumer confidence on balance is reasonably good still, but it is a notch softer than it was before. And I think broadly speaking, we're seeing that in the economy, that it is gradually slowing, that the Fed's rate hikes are starting to have effects. The consumer's red hot expenditure on services is starting to slow a bit. We're probably still several more months of strong spending that are in the pipeline. But our sense is by the time we move into the fourth quarter, we're likely to be seeing a more marked slowing and possibly even a recession.
Yeah, I mean, it sounds like looking through notes that you think things aren't great, but they're not as terrible as the headline suggests. I wonder to what extent you think the banking crisis has really hit confidence at the consumer level. We've been trying to make sense of some of these moves in the market, but if you talk about a sentiment, to what extent has that been hit as a result of what we've been seeing in the financial sector?
This is a really important question. And when I look at this Michigan survey, what's really striking is that expectations component, where people are asked, what do you think the economy is going to be like in 6 to 12 months? That reading fell quite significantly and is softening up at a fairly rapid rate. And you kind of step back and you say, well, what might be driving that? And I think part of it is Fed rate hikes. But I think also people are taking note of some of these banking sector stresses, and it's causing them to be a notch more cautious about spending and their attitudes going forward. And for what it's worth, this past week, in the Fed's senior loan officers survey, we also saw some marked evidence that firms were pulling back on their demand for credit. And I think for very, very similar reasons. So I think it is fair to say that these headlines that we're seeing of financial stresses, of bank failures, of financial uncertainties are weighing to some extent here on consumers, on businesses. And I think they will ultimately weigh to some extent on spending in the economy and be another downdraft over the next, say, 3 to 6 months.
Nathan, the high probability that you were referencing before in terms of a recession in the fourth quarter, maybe starting to show signs of the recession in the fourth quarter. How deep of a recession are you expecting?
Well, our baseline is that by historical standards, the recession will be relatively mild. And by that, we mean maybe it lasts a couple of quarters. The unemployment rate will rise from roughly 3.5% at present up to somewhere in the 5.5% range. This will be a painful event, but by historical standards, relatively mild. Now, if in addition to Fed rate hikes and some pulling back by consumers and firms in their expenditures, if in addition we're seeing continued financial headwinds and market pullbacks in credit and tightening of credit conditions, then I think we have to consider the possibility that the recession might be deeper and more long-lived than what I just described. But that's not our baseline. That's a downside case, but it's one that we're thinking hard about given current circumstances, and is certainly one that we put some probability on.
Nathan, what's the one risk, downside risk, that you think the markets are overlooking right now?
That is always a tricky question to answer, because I think the markets are very effective at monitoring and finding risks. As I've said, we're certainly very worried about various aspects of the banking sector situation. And we're also watching closely and worried about the debt ceiling and everything that might mean. But if I were to move beyond that, inevitably what I've seen in my career is that when we all get grim, we're surprised on the upside. And when we all get bullish, we're surprised on the downside. So maybe the upside that we're not thinking hard about sufficiently in detail is, over the last several years, the U.S. economy has shown extraordinary resilience. And maybe we're underestimating the possibility, notwithstanding all of these risks and shocks, maybe we're underestimating the possibility of a soft landing, and that the economy, as it has shown over the past several years, remains resilient and performs better than we had expected.
I like that, Nathan, the optimistic outlook there on that, the fact that maybe we could see a soft landing. Nathan, how do you think the Fed has been looking at all these data points that we've gotten out over the last week or so, the latest employment report, the latest readings on inflation, and what that means for the next meeting next month?
I think these numbers set the Fed up to have a very vigorous debate about the next stages of policy. I would say, on balance, that payrolls report will provide ammo for those that are more hawkish, that we're still creating a lot of jobs. And the average hourly earnings number in that print was very strong. In contrast, the CPI report showed some hints of maybe softening. And certainly the markets liked where the services inflation number was, and particularly the non-shelter services. And maybe that provides a little bit of fodder for some of the doves. But it really feels to me like that the Fed has a vigorous debate about where the economy is at the moment and how to think about these ongoing financial sector stresses that continue to percolate. And what is the appropriate policy? What's the right setting of monetary policy given those financial stability stresses as well? Our feeling is that it will be a close call, but that on balance, the Fed is likely to hike another 25 basis points at this next meeting, but to continue to make clear that it's going meeting by meeting and it's watching the financial stability, the banking sector risks very closely, and is prepared to respond as necessary to them.
Yeah, that certainly has been the message from Powell from the last couple of meetings. Nathan Sheets, great to have you, Citi Global Chief Economist. Have a good weekend.
Thank you.
All right, coming up, a wild ride for Robinhood shares, closing the day sharply lower after a big gain on earnings earlier this week. A conversation with the CEO straight ahead.
Robinhood shares closed the day down nearly 10% after posting strong gains yesterday on earnings. The online brokerage company announced a 24-hour trading platform 5 days a week that's set to launch next week. Robinhood CEO Vlad Tenev sat down with Yahoo Finance earlier today to talk about diversifying the company for the upcoming quarter. Take a listen.
Yeah, absolutely. I've been incredibly proud of the work that we've done to diversify the business. You know, before you had mentioned Robinhood did quite well in a zero rate environment. So the question was, can we adapt to a high interest rate environment? And when rates started their rapid rise last year, we saw opportunities for our customers. We doubled down on improving the customer experience for our more active traders. And we also rolled out products like Robinhood Retirement, which is the first IRA with a built-in 1% match, as well as Robinhood Gold, which gives customers 4.65% APY and up to $2 million in FDIC insurance. So customer behavior certainly has changed, but I think we've been doing an amazing job just giving customers the things that give them the most possible value given the current market environment. 24/5 is another example of not just giving a product that active traders really value and allows them to manage their risk better, but it's us pushing the industry forward and innovating in the same way that we did by launching zero commissions and no account minimums, the same way we did by launching fractional shares trading, and of course with the recent gold and retirement offerings. So trading should be round the clock. It should be untethered from U.S. East Coast working hours. And I think this moves it a step forward and really closer to what it should be, which is technology rather than some brick and mortar legacy institution.
Vlad, Brian here. Good to see you here back on Yahoo Finance. Do you think these initiatives will help attract the next generation of investors?
I think we've always been focused on the next generation of investors. I think for 24-hour market in particular, there's two things that two groups of people is very useful for. One is active traders who want to be able to react to breaking news no matter what time it arises and manage their risk. Also, I think it's very useful. You may have noticed on the earnings call that we've been talking more and more about how we're expanding internationally. A big part of our mission is making our services available to people outside of the US who in some cases are even more underserved than American consumers. And the experience of investing is more difficult overseas where there's very little overlap with sort of wake hours. So I think this sets us up well to serve those customers and provide them a native experience, much like those in the US get.
A product feature like this doesn't roll out unless there is a significant kind of additive or net benefit, right, Vlad? So what type of revenue additive do you foresee 24-hour trading giving Robinhood or providing to the business?
Well, I think clearly we think that this is going to lead to increased volumes, but perhaps the most important thing is just increased customer satisfaction. If you look at active trader net promoter score, that's up 30 points year over year. So our active traders are very, very happy, even in the face of kind of the challenging macro environment. Overall customer NPS is up 20 points year over year as well. And we believe if we keep innovating and keep our customers happy no matter what the macro conditions, then it's all part of deepening our relationships with our customers even further. And 24-hour market is sort of certainly a component of that.
Vlad, in reading through your conference call and your earnings statement, I've been trying to wrap my head around the different ways that you guys make money, back to this sort of diversification idea. You're not a bank, right? When people deposit money with you guys, it's custodied elsewhere, is my understanding. But you do make interest income on those assets. How does that work? Do you pay a fee to the bank and then you can invest that money and collect interest income? Like, what's the sort of mechanism there?
So there's a couple of different products that come into play here. You might be talking about the Robinhood Gold offering, where customers get 4.65% APY on their cash and $2 million in FDIC insurance. So that's actually, it's a really interesting type of product. It's called the bank sweep product. So what happens is we sweep customer cash to a network of up to 8 banks. Starting June 1st, the number will go up to 8, which gets you the $2 million of FDIC insurance per customer. And what happens is those banks give the customer the high rate and they give us a rebate. If you look at the 4.65% APY right now, it is an incredibly competitive rate. It's hard to beat. But part of the reason for that is the Fed has raised the Fed funds rate to north of 5%. So there's just more interest income to be had, and we're passing a very large portion of that to our gold customers.
And that was Robinhood CEO Vlad Tenev speaking to our morning team earlier today. Well, coming up on the other side, how mortgage rates and the home buying process could change if the U.S. defaults on its debt. We're going to talk with a senior economist from Zillow after this short break.
As the debt ceiling talks drag on in Washington, there's a new warning about what it might do to the housing market. Real estate company Zillow saying that if the U.S. does default on its debts, mortgage rates are going to go through the roof. Joining us now is Zillow senior economist Jeff Zucker. Jeff, it's good to see you. Jeff Tucker. Sorry about that. Jeff, break this down for us. When we talk about the impact that a debt default is going to have on the housing market, mortgage rates are going to jump by how much?
Yeah, we have estimated that they might jump as high as 8.4% based on the current relationship with the 10-year Treasury yield. And really at the root of that, what it's coming back to is the concern about systemic risk in the financial system as everyone begins to doubt the collateral and their counterparties anytime they're making loans. What that means for consumers and home buyers is borrowing costs are likely to rise really substantially.
To what extent has it already seeped into the thinking around home buying right now?
I don't think we've seen too much impact yet. We've certainly seen the 1 month and the 3 month Treasury bills already see their yield rise pretty astronomically in the last couple of weeks. I think a lot of folks are still, expecting and hoping that resolution to the debt ceiling crisis comes along so that this won't actually impact those long-term yields, long-term borrowing costs. So at the moment, I don't think it's quite yet filtering through, but just because it's unlikely doesn't mean it's impossible. And so one of the reasons we did this research was just to highlight what a serious issue it is and why it is so important to come to a resolution on the debt ceiling and hopefully never find out exactly what does happen if we crash through it in default on the debt.
Yeah, hopefully we don't. Jeff, what are you seeing just in terms of activity today and how that compares to some of the expectations that we had headed into this year when we initially thought that maybe mortgage rates would be a little bit lower than where they are today?
Yeah, borrowing costs do remain high. They've been quite volatile. They're still bouncing around between 6.25% and 6.5% on a 30-year mortgage. That's a lot more interest that home buyers are paying. And I think maybe the biggest surprise of the spring home shopping season is how many buyers are kind of forging ahead in spite of that. Buyers kind of went missing in action in last fall and last winter. There was a lot of concern that home prices might even decline this year. And instead, a lot of buyers have kind of come back to the market. They're out there shopping for homes. Yes, it's a lower level of activity. Fewer homes are trading hands. But a big part of the reason for that is when those home shoppers have returned to the market, they're not finding as many listings as they would have hoped for, or as we would expect in really any previous spring selling season. There just aren't that many new listings hitting Zillow every week as we would expect or as home buyers would like to see. So the ones that do come to the market are getting a surprising amount of competition and actually seeing the prices get bid up again.
Well, that was my next question there. What does that mean for prices? I mean, you have to imagine those who maybe sort of sat out for a few months, coming back into the market, realizing the inventory still isn't there, but the same buyers are there. That's got to be a bit demoralizing. I mean, how much higher are prices spiking right now?
So luckily they're not spiking. You know, we're not back to the frenzied spring shopping season of 2021 or 2022. Our home price index is rising at about a 1% pace, not seasonally adjusted. So that's not a spike, but it is a sort of competitive spring shopping season. Homes are selling in a median of 10 days to go pending. That's a bit slower than last year when it was just 6 days for the typical home to go pending in April. But, you know, compared to any time pre-pandemic, that still qualifies as a very fast moving market. So I think that underscores for buyers that, you know, it's not too hot to handle like it may have felt last year or the year before, but you need to be prepared to move quickly in a market like this. If you see a home that you like, you need to be pre-approved, you need to be working with an agent so you can be one of those folks who makes an offer on it within the first weekend or by that offer review date on Monday or Tuesday.
Higher prices, higher rates, certainly a tough environment for prospective home buyers. Jeff, when you talk about the inventory issue right now, do you see that improving at all? And what will it take in order to get there?
Yeah, the inventory is quite low. I think part of the story is that so many existing homeowners locked in a mortgage at 3% or less in some cases. And so for them, if they need a big mortgage on their next home, that presents a really high hurdle to moving. They'll pay a lot more interest when they move. I think it's important to remember, though, that many home buyers own their homes outright. Many of them, many of those folks who might move maybe are thinking of retiring from, you know, Boston or Seattle, moving to Florida or Phoenix, and they might be able to buy that home they're retiring in cash. So there's a lot of scenarios where people could be coming off the sidelines. I think as folks hear the news that that homes are selling quickly and prices haven't actually particularly fallen, that could draw some more sellers out. And then probably the elephant in the room here is new construction. So home builders have absolutely heard this news that there's not much existing home inventory to compete with them. So they are kind of filling the void. They are continuing to crank through and complete the homes that they started building last fall, you know, last year, as they suddenly see buyers lining up to buy them again.
Yeah, certainly there is a very strong demand for homes out there and far from the supply that we need. Zillow's Jeff Tucker, thanks so much.
Thanks for having me.
Well, coming up, despite lower inflation and a strong labor market, President Biden's approval rating remains low. We will dive into the latest Bidenomics on the other side. The regional banking crisis sparked by the collapse of Silicon Valley Bank has also hit fintech companies like Venmo, Stripe, and Square. Their valuations have plummeted, and it's harder to raise capital. Yahoo Finance's Ali Garfinkel was at the 2023 Milken Global Conference to find out how fintech is faring in these uncertain times.
Milken 2023. I am here with Nicole Valentine. Nicole, thank you so much for being with us.
Thank you for having me on Yahoo Finance. I'm happy to be here with you.
So I want to start out by testing out a thesis with you. Compounding bank collapses, Silicon Valley Bank, Signature, First Republic. Have those bank collapses made fintech more important than ever?
It has. And the great thing about fintech is not scared. Fintech is not scared of a crisis. It actually looks at a crisis head on and figures out how to innovate. They look at what are the various ways that we can build, what are the ways we can innovate and get things done. And a crisis for fintech is just another opportunity to figure out what's next, how are they going to reach their customer, how are they going to deliver value, and how are they going to get more sticky in a moment like this.
And can fintech come out of these collapses more sticky? What would that look like?
Well, first of all, fintech is expansive. And when I look at different phases of a business cycle, this theme is all about thriving. We're talking about thriving in an advancing world, making sure that everyone's thriving. But there's three stages. There's surviving, there's building, and there's thriving. So fintech is always building. Fintech is always building on top of new technology. So we talk about generative AI, we talk about blockchain. That's how fintech keeps moving through cycles. It doesn't stop the builders, and it doesn't stop those from coming out of a space and saying, what's next?
So talk me through what the outlook for fintech is, because you've been across the world actually talking to people about fintech. So I'd be curious about here in the US and more broadly.
So it's interesting, when you look at different markets, every market, you're meeting a market where it is. So I spent a lot of time this year in Singapore. We've been to the Middle East, Abu Dhabi. We are focused on Africa, and we're obviously focused on the US, Latin America, and we're out here looking at the different ways that people are attacking and attracting fintech innovators, investments, and where they are. So I would say for the US, we're a very mature market. We have a tech edge. We have investment edge. And so you're going to see a lot of fintech coming out of the US, and people are not stopping in this space. When you're looking at the Middle East, you're looking at a lot of investment. They're also attracting their policymakers. Their authorities are welcoming. They're open for business. The EU is open for business. And so when you look at different markets, you're looking at where is the opportunity. When you go to Africa, there's a very digital native population that's ready to kind of go into tech, and they're ready, and they're actually innovating. They've leapfrogged, and they're at the space where everyone's in tech there. So I think that the outlook for fintech is really amazing. I think that any transaction that has a tech edge is considered fintech. Whether you're an organization, a corporation, or whether you're a startup, you're looking at where is my next tech moment? How do we use this tech appetite to build acumen so your users are out here doing more and being more productive with your tech?
Yeah, the picture you're painting, Nicole, is really expansive, but there's also a lot of doom and gloom talk about a possible recession. So how does fintech fare then in a recessionary environment?
I look at fintech as recession-proof. And when I say recession-proof, I mean that fintech is not going to stop its movement. It's going to keep moving because there's always opportunity to build even in a recessionary time. It just means that you have to figure out, where does your customer, where does your user, where does your client, where are they going next? And making sure that fintech meets that need at every space of your life. I know fintech startups that have built and have gone out there in down cycles. They figured out how to get lean. They figured out how to get smarter and build more quality into their product. And that's what it's about. It's about quality. It's not always about size.
That's really interesting. So talk to me then, looking forward, how, if you had to distill it down, what is the outlook for fintech right now?
The outlook for fintech I see is this. I think about this in a big picture. We're here at the Milken Institute. We have the top leaders in business from all around the world. And I think everyone's asking themselves, what is the wealth of a nation? What is the wealth of your nation? And a lot of people are saying wealth is about human capital, human opportunity, human creation, ability to create. And fintech is right in the center of that. The outlook is, whenever you want to build the wealth of your nation, you have to go to fintech first, build from there, and make sure that it reaches the people so everyone can have economic mobility.
And actually, while we're here, before I get to the last question, how do you define fintech?
So I believe fintech is very broad, but I'll say this. Fintech is any transaction, any financial transaction that utilizes technology to scale its impact and its usage. So that's whether technology can be AI, cloud computing, blockchain, and the transaction can be anything from lending to currency to payments. And so whenever you're talking about any of those transactions and the technology that goes in and powers it up, that's fintech.
What are your expectations for how a possible interest rate increase might affect fintech?
So here's the deal. It's very possible. And when you're talking about, impact, for me, I'm seeing that there's not going to be a decrease in terms of the amount of activity that's out there. It may impact, and hopefully it doesn't impact the jobs and the talent that are going to be deployed to make sure that fintech are being built. But I have a feeling that fintech is just going to keep going no matter what happens, whether there's an increase or whether there isn't. We're going to keep pushing on and making sure that we're thriving no matter what.
I don't know if I've ever heard anyone make fintech sound sexier. Nicole, thank you so much.
Thank you so much, Allie. I enjoyed speaking with you, and enjoy the rest of Milken Institute Conference.
That was Yahoo Finance's Allie Garfinkel at Milken's Global Conference out in California. Akiko?
Well, inflationary pressures are easing as the labor market remains resilient, yet a majority of Americans still aren't happy with President Biden. Joining us now is Yahoo Finance senior columnist Rick Newman. Rick, how much of this has to do with messaging coming from the White House?
I think it's actually about the real underlying economic problem, which is inflation. We got a new poll this week showing that Biden's approval rating is all the way down to 36%. That's kind of unbelievable, given that we have an unemployment rate of 3.4%, which is the lowest since 1969. Bank of America put out an interesting research note this week showing that the last president to have a lower approval rating than that with unemployment below 4% was Harry Truman, all the way back in the early 1950s. And that was in the middle of an unpopular war, the Korean War, McCarthyism, and other things that were going wrong back then. So Biden just has a major problem with voters. Inflation is now going in the right direction. We got news this week. It was down to 4.9%. That's down from the peak of 9% last June. But man, voters are just in a foul mood. And I did a little digging into this week. And, if you look at inflation over the last 2 years, it shows you that consumers are absorbing around 14% overall price hikes during a 2-year period. That is more than wages have been going up. So I think we have to remember that even when you see that annualized rate of inflation coming down, those are price hikes on top of other price hikes. And this is all cumulative. So this tells me that consumers are just feeling worn out by inflation.
Rick, what does it tell you about 2024? Because we know the economy, obviously a very critical issue for voters. How does Biden stack up to what we heard about Trump and his handling of the economy?
Well, of course, most voters don't want a Biden-Trump rematch. I keep reminding myself this is 18 months away. Trump, for his part, he's probably going to have a morass of legal problems over the next 18 months. And it is possible that one or both of these guys actually does not end up being the nominee for whatever reason. But Biden should be in a pretty good spot for re-election. There have been some early 2024 election modeling, and that shows that with the labor market as strong as it is right now, and consumer spending as strong as it is, and people's finances are in pretty good shape despite inflation, that ought to really be a tailwind for the incumbent president, whether it's Republican or Democrat. So based on that alone, Biden would seem to be in good shape. But it's just his approval ratings are frankly terrible, given what's mostly good about the economy. And it seems like they're actually going down, not up. So inflation is just a huge wild card. I mean, this is one more reminder of how pernicious inflation really could be. We forgot this lesson, because we didn't have any real inflation from the 1980s all the way up until about 2021. But it's a mess, and it's a big problem for President Biden.
You say 18 months until the election?
Sorry. I mean, it's great for me. I love talking about it and looking at all the different angles. But I'm afraid we are going to be talking about it that long. And then even worse, Akiko, we're just going to start talking about the next election right after that. We never stop having elections in the United States.
I mean, 18 months is a very long time, to your point. It's a very long time in politics. A lot could change, as you've learned over the years. Rick Newman, as always, thanks so much for that.
A lot of people hope it does change. See ya.
All right, coming up, we recap the top stories from the day and get you set up for the week ahead. Stay tuned. It is closing time here at Yahoo Finance. Let's get you ready for the week ahead. First up, we get a slew of retail earnings next week. Among the big ones, Home Depot, Target, and Walmart. And given today's weaker than expected consumer confidence data, we're going to be looking to see what company leadership says about what consumers are not spending their money on.
We will also get some reads on another key sector of the economy, housing. We will get Home Builder Confidence Index on Tuesday, followed by housing starts on Wednesday. And on Thursday, we will be watching existing home sales.
And finally, on Tuesday, we're going to be watching for a Senate banking hearing on the collapse of Silicon Valley and Signature Bank. The former CEO of Silicon Valley Bank will be testifying, along with the former president and former chairman of Signature Bank.
Well, AI is everywhere, and it's even showing up for a very special day this weekend, Mother's Day, which if you forgot, it's Sunday, so you still got some time to run out and get the ladies in your life as something nice. Well, online flower delivery service 1-800-Flowers.com has launched a chatbot called the Momverse, which according to the site can create original content like poems and songs. Yahoo Finance's Diane King Hall has been looking into this for us, and everyone is getting into AI, it seems
I know. I was like, come on. But I did, engage. So you input a little bit of information, and this is what it spit out for me. It said, Mom is the headline. A treasure trove of trinkets, jewelry with stories to tell. Mom's writing flows like a river with words that weave a spell. Her heart shines bright like rubies, and her love is an endless gleam. Oh, there's my son right there. That's Ethan. And her love is an endless gleam. Here's to the greatest mom ever. An angel in our life, sweet dream. I put that in about my mom. Hopefully Ethan says that to me, right?
I was going to say, that's pretty good. And there's my two kids up there, Stowe and Gray.
I love it.
I love the thought of this, and I get why they're doing it. It makes a heck of a lot of sense. But Akiko, wouldn't you rather, when your daughter gets old enough, she's able to write cards? My sons can't write cards either. Oh, look at her. She's so cute. Wouldn't you rather? You would rather get something personalized from her.
Yes, 100%, Shauna. I was thinking that. I mean, we're not asking a lot on Mother's Day, right?
Yeah.
Just something personal, though. Don't use AI. Don't use tech on this day.
Fair.
Doesn't have to be elaborate. Just something from the heart.
That's fair. It's true. But when they're as young as you guys kids are, and still, even my son, like he knows how to write now, but the teachers help them do stuff. Because I will say though, he came home with something the other day that it was clear he was supposed to fill out. He is a sweetheart. However, he did not fill out this like my mom is, this, that.
He's still got time. He's got 2 days. Akiko, this is your first Mother's Day with Mayari. What are you guys doing? Any fun plans?
Yeah, well, we are going out to brunch. We got to celebrate my mom too, right? But I have to say that I'm approaching this Mother's Day completely differently because you do really have a new appreciation for moms out there. I mean, I've only been at this for 4 months. I don't know how my mom handled it with 3 kids. Let's put it that way.
I love all the pictures we have of the babies. Oh, that's our executive
producer's that is precious.
Baby. Oh, I love it. I love it.
Yeah, she's right around Mayari's age too.
There's Miles. Oh,
and
man.
Miles too. All right, guys. Well, that does it for us today on Yahoo Finance Live. We wish all the mothers out there a very, very happy Mother's Day. And Diane and Akiko, happy Mother's Day to you guys as well.
So have a great Mother's Day to you too.
We will see you guys all back here on Monday.